You file your first invoice, the money finally hits your account, and then you realize you have to pick a business structure before you even know if this thing will survive 3 months, because your bank wants paperwork, your first client wants a W-9, your co-founder wants equity, and your brain is screaming, "Can I please just build the product?" The painful truth is that this choice can either keep your taxes boring and predictable, or it can quietly cost you thousands, especially when you start hiring, raising money, or paying yourself like a real adult. My name is Hector, and I help founders make tax choices that don't explode later. Because the biggest mistake founders make is choosing a structure based on what sounds cool, or what a friend did, or what a TikTok tax guy said, instead of choosing based on what you're actually optimizing for. If you're bootstrapping, your goal is usually simplicity and cash flow, while if you're raising venture capital, your goal is usually investor compatibility and clean equity. And if you're building something that throws off profit early, your goal is usually lowering the combined tax hit without creating paperwork chaos. Stay until the end, because I'll give you a simple decision framework you can use in 5 minutes, and it will make the right option feel obvious instead of mysterious. The cleanest way to think about sole proprietorship versus LLC versus corporation is to separate legal structure from tax treatment, because people mix them together, and that's where confusion starts. The IRS basically frames the common forms as sole proprietorships, partnerships, corporations, and S-corporations, while also pointing out that an LLC is a state law legal structure that can be taxed different ways depending on elections. So when someone says, "Get an LLC for tax savings," what they usually mean is, get an LLC for liability protection and then choose a tax classification that fits your situation, because an LLC can be taxed as a sole proprietorship if it has one owner, as a partnership if it has multiple owners, or it can elect to be taxed as a corporation. Now let's start with the default option most founders accidentally begin with, which is a sole proprietorship, because if you start selling on your own with no entity, you're basically there by default. The upside is that it's simple, it's cheap, and you can start today without asking permission, which is why it's perfect for validating an idea, testing pricing, and learning whether customers even care. The downside is that simple does not mean lightly taxed, because once you have real profit, you're generally paying income tax and also self-employment tax on that profit, and that self-employment tax is not subtle. The IRS states the self-employment tax rate is 15.3%, made up of Social Security and Medicare components, which means profitable self-employment can feel like you're paying a second tax bill on top of income tax. This is why a lot of founders graduate from sole proprietor to LLC once the idea is working, because an LLC can give you liability protection without forcing you into corporate complexity, and by default, it still keeps pass-through taxation. In plain terms, pass-through means the business itself usually doesn't pay federal income tax as a separate entity because the profit passes through to the owners and you report it on your personal return. That pass-through setup has 2 huge startup benefits that people forget. First, if you have early losses, those losses may be able to offset other income depending on your specific situation and limitations, which can be meaningful if you're leaving a job and your startup is bleeding cash early. Second, pass-through owners may qualify for the qualified business income deduction, which is a deduction of up to 20% of qualified business income for eligible owners. And in 2025, the One Big Beautiful Bill Act made that QBI deduction permanent instead of letting it sunset, which keeps pass-throughs attractive for a lot of small businesses. So if you're a solo founder or a 2-person team building something cash flowy like an agency, a niche SaaS, a coaching business, a local service business, or an e-commerce brand that won't need institutional investors, a plain LLC taxed as a sole proprietorship or partnership is often the sweet spot. You get credibility, you get legal separation, you keep pass-through taxes, and you don't automatically sign up for corporate formalities. Now here's where the conversation gets spicy, because the internet loves to shout, "Make an S-Corp," as if it's a cheat code, and the truth is that it can be a great tool, but only when the math and the discipline match your reality. An S-corporation is not a different kind of company you buy at the store, because it's a tax status you elect for an eligible entity, typically by filing Form 2553. The reason founders like S-Corp taxation is that it can reduce exposure to self-employment taxes by splitting owner pay into wages and distributions, but that only works if you do the boring part correctly. The IRS is very clear that S corporations must pay reasonable compensation to shareholder employees for services before making non-wage distributions, which means you can't magically pay yourself a tiny salary and call the rest distributions without inviting trouble. So the practical rule is that S-Corp election starts to make sense when you have consistent profit beyond what a reasonable salary would be, and you're ready to run payroll, file payroll reports, keep clean books, and treat your business like a real operating system instead of a side project. If you're still in chaotic early stage mode where income is random and expenses are messy, an S-Corp can turn into a paperwork machine that costs more in fees and friction than it saves. Now let's talk about corporations, because corporation usually means a C corporation in the US, and it is a completely different vibe. Unlike pass-through entities, C corporations pay tax on corporate profits, and then shareholders can pay tax again when profits are distributed as dividends, which is why people call it double taxation. The reason anyone chooses this anyway is because a C-Corp is often the cleanest structure for raising serious outside money, issuing stock options, scaling ownership, and planning for an exit, and the tax cost can be worth it if your business is designed to grow aggressively. The U.S. also taxes resident corporations at a flat 21% federal rate under current law, which can look attractive if you're reinvesting profits into growth instead of distributing them. This is also why you constantly hear Delaware C-Corp in startup circles, because venture capital firms often prefer C corporations, especially Delaware C corporations, since the legal framework and share structure are predictable and investor-friendly, and pass-through entities like LLCs can create tax reporting headaches for certain investors. So here's the framework that makes the decision fast, because you're not choosing a label, you're choosing a trade-off. If you are building a lifestyle business or a bootstrap business where you want profits to flow to you, pass-through structures like sole proprietor or LLC are usually your friend, and you can later consider an S-Corp election once profits are stable enough to justify payroll and compliance. If you are building a venture-scale startup where the plan is outside investment, option grants, and a potential acquisition or IPO path, starting as a C-Corp can save you messy conversions later, even if it feels like overkill today. The next hidden factor is cofounders, because the moment you have more than one owner, you need a structure that cleanly documents who owns what happens if someone leaves, and how decisions get made. You can do that with a multi-member LLC and a strong operating agreement, and plenty of startups do, but the more you anticipate complex equity, investor rights, and option pools, the more a corporation starts looking like the boring, standard container that investors expect. There's also the timing trap that founders miss, which is that tax elections have windows, and elections aren't always magic retroactive erasers. For example, the IRS notes that an LLC that wants to change its default federal tax classification uses Form 8832, and that the effective date generally can't be more than 75 days before filing, or later than 12 months after filing, which means waiting too long can limit your flexibility. If you're enjoying this because it feels like someone finally made the decision logical, subscribing is worth it, because startup taxes get expensive when you let vibes drive choices. Now, quick international reality check, because a lot of you build in one country and sell in another, and the words don't always map perfectly. In the UK, the nearest sole proprietorship concept is being a sole trader, and the nearest corporation concept is a limited company. And the same big idea applies. Sole trader is simpler, while a limited company is a separate legal entity with different tax and admin rules. So if you're in Europe watching US startup content, don't blindly copy entity choices, because the correct move depends on your local tax system, your residency, and how you plan to pay yourself. The decision logic is still universal, though, because you're always balancing simplicity, liability protection, how profits get taxed, and how easy it is to bring in investors. One more compliance landmine that founders keep tripping on is paperwork obligations that have nothing to do with income tax, because the last few years have been full of reporting changes. For example, in the U.S., beneficial ownership information reporting under FinCEN's Corporate Transparency Act rules has shifted, and FinCEN has stated through an interim final rule that U.S. companies and U.S. persons are exempt from BOI reporting requirements, while certain foreign entities may still have deadlines, which means you should always check whether a compliance headline actually applies to your entity. Now let's make this painfully practical, because you're probably thinking, okay, Alex, just tell me what to pick. If you're in the idea to first revenue stage and it's just you, Staying as a sole proprietor while you validate demand can be perfectly rational, as long as you understand you're not getting liability protection, and you're likely paying self-employment taxes on profit. If you're earning steady revenue, signing contracts, working with clients, or selling something that could create liability, a single-member LLC is often the simplest upgrade because it changes the legal wrapper while keeping taxes straightforward, and you can later elect different tax treatment if the business grows. If you're consistently profitable and you're paying meaningful self-employment tax, an S-Corp election can be worth exploring, but only if you're ready to run payroll and pay yourself a reasonable salary, because that's the rule that keeps the strategy legal and boring. If you're planning to raise venture capital or you want the cleanest path to issuing options and taking investment, a C corporation, often a Delaware C corporation, is usually the path of least resistance with investors, even though it's heavier on formalities and can introduce double tax dynamics when profits are distributed. And here's the part people never say out loud: you are allowed to change as you grow, and most real businesses do. The best founders don't obsess over being perfect on day one because they choose something defensible for the next 12 months, keep their books clean, and then adjust the structure when the business has earned the complexity. If you want a shortcut that turns this into a 5-minute decision instead of a 2-week spiral, I have a simple startup entity decision sheet that asks you the handful of questions that actually matter, like whether you're raising money, whether you'll have co-founders, whether you expect early losses, whether profits will be distributed or reinvested, and whether payroll is realistic this year. And then it points you to the structure that usually fits with a short list of watchouts to discuss with a professional. Because the goal isn't to become a tax expert, it's to choose a container that won't punish you for growing. And the moment you stop treating this like a personality quiz and start treating it like a cash flow and fundraising decision is the moment the right answer shows up. Which means if you're bootstrapping, you keep it simple and flexible. And if you're venture-bound, you choose the structure investors already know how to fund. And if you're already profitable, you stop donating money to the self-employment tax bucket unnecessarily while pretending it's just the cost of being a founder. So grab the sheet and make the call this week, because every month you wait is another month your business is growing inside the wrong container, and you're the one who pays for that later when it's hardest to unwind. So pick the structure that matches your actual plan and then get back to building, starting right now before the next contract or investor email forces the decision on you in the most stressful way possible, which is exactly when founders make the worst choice. So don't do it under pressure. Do it today, and then move forward with a structure that fits what you're actually trying to build, because once that part is locked in, everything else gets easier, including hiring, paying yourself, raising money, and explaining your business to banks, investors, and future you. So if you want the decision sheet, it's there. And the moment you use it, you'll know whether you're staying simple, electing S-Corp, or going full C-Corp. And then you can stop guessing and finally act on it.